044.
Welcome back, folks. Dow right now is down 56. You get the NASDAQ off 12. S&Ps are down 6.5. And as we do each and every Monday at 20 past the first hour, we have our man, Mr. Steve Rhodes. Now, don't forget, folks, at TFNN, every Monday, Wednesday, Friday, we start live programming at 8 o'clock in the morning and go to 5 in the afternoon. Tuesday, Thursday, we start at 7 o'clock in the morning, go to 6 in the afternoon. All that programming, you get right on your cell phone. You just go to TFNN.com. You hit Tiger TV. Our man, Mr. Steve Rhodes, has a great show on every trading day, 1 to 2 Eastern Standard Time. Also has a great newsletter. It's called Mastering Probability. Now, as you come over to TFNN, you're going to see right in the top of the carousel, trading range boundary lines. So he is doing a workshop for subscribers this coming Wednesday. That workshop is going to be from 5 to 6 Eastern Standard Time. Normally, his newsletter is $149 a month. You can get the newsletter for a full month, and the workshop, plus 4 other workshops that he has done, all for $49, folks. Check it out right on the front page of TFM. We're going to talk to our man, Steve Rhodes, about this right now. Steve Rhodes, what's going on?
That's 13 cents a day.
13 cents. I love it, man. That's a lot more than 13 cents a day. Oh my God, that's pretty sick when you think about it.
It is when you really put it in perspective.
That's cool. Yeah.
And in essence, this really, Tom, is really, if you combined all 5 of these workshops, 6 of these workshops that in essence clients will get, it's the equivalent of a master trader course.
Yes.
Which was how you and I met. So what I'm going to cover here during the, so this is this Wednesday, 5 to 6 p.m., as you said. And at this specific workshop, we're going to take a look at horizontal and diagonal levels of support. There's somewhat, the horizontal ones are more of a hidden area that I'm going to be able to bring out for folks. And they work on all time frames, all vehicles out there. We'll take a look at the A to B equals CD patterns with inside those levels. And just as an example, so let's just take a look at the S&P 500 right now, so that folks that are listening and watching at Tiger TV, they can see the actual horizontal trading range boundary lines for the S&P 500. Now, if we take a look at where price actually stopped back in 2000 and in 2007, you can see the 1551 solid line on my chart. Really, these boundary lines, these ranges, were actually formed years prior. Those are the large dash lines out there, the 1327 and 1102 area. So if we take a look at where the S&P 500 is right now, odds favor that we're going to eventually see a test of that next upper range boundary level, which is 2224, and we're around the 2120-ish type area right now. So from a longer term trader standpoint, this is a monthly chart we're looking at.
Yes.
Red lines on my chart, I always refer to monthly. That's what the message is. Now, when we take a look at those horizontal trading ranges, we can also go ahead and split those in 2 to find a midpoint. So what's interesting here, and again, all this was set up, this is data going back to 1996. And so I try to use as much data as I can because it provides us with levels of support and resistance that price tends to gravitate to. And when we take a look at the consolidation, the shorter term consolidation that we've been in for the last couple of years here, we can see at that midpoint level inside the S&P 500 around 2112 had contained price for quite a while. Now, in the last couple of months, we've gotten above that, or the S&P 500 has gotten above that. So this 2112 area is an old level of resistance. It's now being tested as support. We'll see if the S&P 500 can bust through that. If it does, it tells us that price could head one more time back to the 2000 area. The trend is our friend. This is the diagonal. This is the rising price channel that is in play out here. So that's not in jeopardy with regard to the trend not being our friend inside of the S&P 500. There's something else that we know, and both you and I we love to identify a market that is consolidating as quickly as we can, because inside of that pattern, then you are setting up where your back is up against the wall, either on the upper boundary or the lower boundary. Well, in the S&P 500, it had been trading in a long-term 800-point consolidation going back to 1996, as a matter of fact. We broke out of this in 2013. Now, folks, the beauty of a consolidation pattern is that it also gives us what's referred to as a measured move price move. We take that consolidation, and if price breaks the upside or the downside, we can just simply add that consolidation level to that breakout. So inside the S&P 500, another piece of information that bodes well longer term is that this has a price measured move in the 2350 area. Now, when you break a consolidation, that measured move is equal to or greater than the consolidation. So we have a number of factors that are pulling together here that say that we're going to see higher price, which is different than most of the people that are, on the different media stations that are ambivalent. I am not ambivalent at all. To me, the signals couldn't be any clearer. However, there is a timeout that is in order. And this takes us to the daily chart here for the S&P 500. And it flashed to us a very important warning signal. Now, some of these tools that we see here are included in the other workshops that come with signing up for the newsletter service, for the 13 cents a day. And these are very important signals for us to pay attention to. So in the S&P 500, the bottom portion of this screen here is the price oscillator, which is a difference between two exponential moving averages. The red line on my chart on the price data area is what's referred to as the oscillator unchanged line. Now, the beauty of that red line is that in an instant, I can take a look at where price is at, and when price is above that level, that tells me that the price oscillator is riding. That basically means that it is a bullish bias message. When price starts trading below that level, that says that it really is sellers that are ones that are in control. Even if the market is starting to move up a little bit, it's nothing more than getting back to a level where you would take a look at short positions. But in this chart here, you're going to see 6 diagonal arrows. 3 on the bottom panel in that price oscillator area, and 3 up at the oscillator unchanged line in the price area. What's most important about this indicator, Tom, is that when it turns down below 0, it sends a very negative message. Now, what's really important is being able to spot when the market turns out here. So this doesn't tell us when the market will turn. Subscribers of Mastering Probability will know that in a heartbeat because of the different tools that are either included with the workshops, the other workshops that we use to identify turns. But right now, the message, as long as the S&P 500 trades below 2143.76 to be exact, it's nothing more than any counter trend rally. If price gets above that, then there's a little bit of a different picture. But we can see going back into the 2015 time, back into August, and then into January 2016. Once we saw this exact same pattern, it led to a scary result out there. That's what I'm anticipating. That's what I'm looking for. I hope that that's what we get out there. And folks, you can get all of this for, as Tom said, for $49 for the first month, really 13 cents a day. It's my workshop that is in 2 days on Wednesday, the Mastering Probability newsletter, learning about all of the Japanese candlesticks that you want to help identify, especially if you're a pattern recognition person, the ultimate trading patterns. I give you 3 or 4 trading patterns that you want to use in your trading no matter what it is that you trade. That long short line, that's that price oscillator unchanged line out there, and then my money management workshop. So that's what folks are going to get, and next week, next Monday, let's you and I spend some time on the presidential cycles that are out there, because it's really, really interesting.
And folks, come over to our website at TFNN. You're going to go, you see it right at the very top of the carousel. You can sign up right here, right now. And the second that you sign up, of course, you're going to get all the rest of these workshops, folks, that you can study them. You're going to get a great workshop Wednesday night, 5 to 6. And if you can't make it live, folks, don't worry about it. It's going to be on your page for full 30 days. Steve, thanks so much, man. Have a great one, a safe one. We look forward to the show tomorrow.
Thanks, Tom. Take care.
Stay right there, folks. To come right back.